International Financial Reporting Standards, IFRS. Introduction to IFRS. International Financial Reporting Standards, IFRS, are a set of accounting standards developed by the International Accounting Standards Board, IASB. IFRS provides a global framework for how public companies prepare and disclose their financial statements, aiming for consistency, transparency, and comparability across international borders. History and development of IFRS origins. IFRS began as an effort to harmonize accounting standards globally, with the International Accounting Standards Committee, IASC, being established in 1973. IASB formation. In 2001, the IASB replaced the IASC and took over the responsibility of setting standards. Global adoption IFRS has been adopted by over 140 countries, including the European Union, and is used by most countries except for the United States, which uses GAAP. Importance of IFRS global consistency provides a unified set of standards that enhance comparability across international financial markets. Investor confidence increases transparency and reliability, which helps investors make informed decisions. Efficient capital markets facilitates cross-border investments and improves the efficiency of global capital markets. Key differences between IFRS and GAAP. Principles versus rules. IFRS is principles-based, while GAAP is rules-based. Revenue recognition. IFRS is less detailed and flexible in revenue recognition, while GAAP has more specific guidelines. Inventory accounting. IFRS does not allow the last-in, first-out LIFO method, while GAAP does. Impairment of assets. IFRS requires a one-step impairment test, while GAAP requires a two-step test. Revaluation of assets. IFRS allows revaluation of certain non-current assets, while GAAP typically does not. Core principles of IFRS. Fair presentation and compliance with IFRS. Financial statements must present a true and fair view of the financial position, performance, and cash flows of an entity. Going concern. Financial statements are prepared assuming that the entity will continue its operations into the foreseeable future. Accrual basis of accounting. Transactions and events are recognized when they occur, not when cash is received or paid. Materiality and aggregation. Only material items are presented separately in financial statements. Immaterial amounts are aggregated. Offsetting adding assets and liabilities or income and expenses should not be offset unless required or permitted by IFRS. Frequency of report. IFRS requires at least annual financial statements. Comparative information. Comparative information for previous periods must be disclosed. Major IFRS standards. IFRS 1, first-time adoption of IFRS, provides guidance for companies adopting IFRS for the first time. IFRS 2, share-based payment, prescribes the accounting for share-based payment transactions. IFRS 3, business combinations, outlines the accounting treatment for business combinations, including mergers and acquisitions. IFRS 7, financial instruments. Disclosures requires disclosures about financial instruments and their risk. IFRS 9, financial instruments, addresses the classification, measurement, and recognition of financial assets and liabilities. IFRS 10, consolidated financial statements, establishes principles for the preparation and presentation of consolidated financial statements. IFRS 13, fair value measurement, provides a framework for measuring fair value and requires disclosures about fair value measurements. IFRS 15, revenue from contracts with customers, sets out the principles for recognizing revenue from contracts with customers. IFRS 16, leases, requires lessees to recognize most leases on the balance sheet as assets and liabilities. IFRS 17, insurance contracts, sets out the principles for recognizing and measuring insurance contracts. IFRS framework. The IFRS framework sets out the concepts that underlie the preparation and presentation of financial statements for external users. It provides a foundation for developing future standards and helps in applying existing standards consistently. Adoption of IFRS globally. European Union. Mandatory for all listed companies since 2005. Asia and Oceania, widely adopted in countries like Australia, New Zealand, and India. America's Canada uses IFRS for public companies, while the US uses GAAP, though convergence efforts are ongoing. Challenges and criticisms of IFRS complexity. Some argue that IFRS is complex and challenging to apply consistently. Judgment and subjectivity. Principles-based approach may lead to more interpretation and less comparability. Transition costs. Companies may face significant costs when transitioning from local GAAP to IFRS. Summary. This guide provides a comprehensive overview of IFRS, covering its principles, standards, global adoption, and the key differences from GAAP. It serves as an essential resource for understanding how IFRS shapes financial reporting on a global scale.